Hey, everybody, we are going to talk about one of the most popular income stocks in the news media the past couple of years is a company called Medical Properties Trust, ticker symbol MPW. Before we dive in, please take a minute and check out the link you see on your screen. Get a message from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. The link is fool.com/Frankel. So, medical properties has been an interesting few years, and not in a good way. It's the S&P 500 has been up about 50% in the past couple of years. Medical properties is down 80% in 3 years. It declined 20% in 2024. Um, it's a high dividend stock and has been for a long time, which is why it gets so much investor interest. Right now, it yields a little over 7%. That's after some pretty big dividend cuts that went on. As the name implies, this is a real estate investment trust. It buys primarily hospitals and other clinical healthcare spaces, which can be a great business, but only if your tenants are doing well. These are properties that can be tough to repurpose and things like that. So Tyler Crowe's joining me. Tyler, what can you kind of just give a recap of what's happened over the past year or so, and how have things changed?
Sure. Well, this is a story that's gone on for a couple of years because what happened is, like I said, in theory, it makes good sense. Like hospitals should be good tenants, right? Like hospitals are pretty consistent in terms of the things that happen there. People get hurt, people get sick. They should be good tenants, right? And they tend to sign long-term contracts. Well, Medical Properties Trust had one tenant, Stewart Healthcare. It was their largest tenant. And not only was it their largest tenant, they tended to give the company relatively, like, we'll call it favorable terms on its loans or on its rent rolls. So it would get favorable rates to like make improvements to its facilities, or it would get additional term loans on top of the late loan or the rent that it had to pay for these facilities. And so it seemed like Medical Properties Trust kind of bent bent over a little bit, kind of to twist itself into knots, trying to satisfy this customer because it was its largest one. Well, unfortunately, Stewart went into bankruptcy. They were not exactly a very well-run healthcare facility, and they went into Chapter 11 bankruptcy. And what ended up happening is that Medical Properties Trust had 17 facilities that were more or less unoccupied. This was, I mean, it doesn't sound like much, but because it has 402 properties, but these were some of its largest properties that so like they represented an outside level of rent, and like you said, loans as well. So like their commitment to this company was outsized relative to when you hear like 17 properties versus 402. So when it went bankrupt, basically it could barely even pay its tenant loans. And so during the bankruptcy proceedings, uh, Medical Properties Trust had to figure out like what did they own, like how much could they recoup in terms of like repairs to the facility and all that stuff. They got 17 of them back, and then they have subsequently, and this is where I guess you could say the good news from 2024 is they have subsequently released all of these properties to other people. So most of, if not all, of the issues that it had with Stewart Healthcare are, I would say, we'll call it like 90 to 95% resolved. Like they've moved on, and this was 2024 was, I guess you could say, the lancing of the boil, or whatever sort of graphic term you want to use, because it was bad. Like the company has in the past 2 years has cut its dividend twice. It used to pay 29 cents per share a quarter. It's down to 8 cents a share per quarter, and it took like $1.4 billion in asset write-downs over the past 12 months. So there's been a gigantic reset of the business that, has happened. And it's part of it, and it's reason why it's so low today, and why 2024 was so disastrous, because this was the year where this all came to a head, and the business is now like, okay, it's over.
Yes, you make some really good points, and I mean, yes, they did release those properties, but they're still kind of an anchor for the moment. in the sense that they had to release them at much lower rates than they were getting previously to get tenants in there quickly. Now, those leases will escalate quickly over the next couple of years. By the end of 2025, they'll be at about 95% of the previous rent level. But for now, it's still kind of a depressed amount of income. Um, Debt is kind of still a big overhang on this company. You and I were talking about their balance sheet before we started recording. And right now, this is a $2.7 billion market cap real estate investment trust with about $9.3 billion in debt, over $1 billion of which is coming due this year. And I think it's a little over $1 billion in 2026. It's not going to be able to do this from its cash flow. It's especially with it, unless it wants to get rid of the dividend entirely, and even that might not be enough. Not that it would, but in order to continue to be able to pay the dividend and to be able to satisfy its debt obligations, it's going to need to sell more properties. Now, my general takeaway is that medical properties is now finally on the path to right size its business. It's been selling some properties, it's improved its balance sheet, and to its credit, it has improved the balance sheet. The debt situation looks a lot better than it used to. But if its tenant issues are over, which Stewart was just a big one. They're not the only tenant that was struggling in medical properties portfolio. If its tenant issues are for the most part over, which is a big if, this could be an inflection point for the business in terms of correcting itself into a well-functioning real estate investment trust. Now, what that's going to look like, how many more assets they're going to have to sell, how much debt they're going to end up having to pay off, what the dividend's going to look like when all is said and done, that remains to be seen. But I do think this is somewhat of an inflection point. And like Tyler said, lancing the boil, we went from kind of being in, all-out damage control mode to kind of figuring out how to best right the ship and move forward. I do think growth is a way off before they'll be in a financial position where they can actually grow the portfolio. Um, in a high interest rate environment, not being able to grow isn't the end of the world as a REIT, but as cost of capital in the industry comes down and stuff like that, that's going to be a big handicap relative to peers. Um, but on the other hand, it's over a 7% dividend yield. You wouldn't need a ton of appreciation in the stock price to outperform the market at this point in terms of total return. But it's still a pretty high risk turnaround play. So just keep that in mind if you are going to invest. Any final thoughts, Tyler?
No, I think it needs a little. It's some, like I said, some debt improvements. A lot of it's like out years debts, like the latter half of the 2020s, early 2030s, has really low interest rate debt. So when that does come due, it's probably going to be higher. So it does need to, find some growth somewhere, find some way to pay down principal on some of this debt and a little bit more, which means like your growth as the equity side is probably going to be pretty muted for a while. But like is with its dividend reset, at least as it looks right now, and unless you and I are missing something like egregious in the financials, it looks like it can more or less maintain where it is. But investors shouldn't expect some like massive turnaround from here. I think it's just kind of middle along at this for quite some time, which 7% dividend is okay. And if you're looking for something that's going to pay out income for seemingly reasonable amount of time, then this might be a better fit. But certainly not something that's going to be like a mega growth, beat the market sort of investment.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.